Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's Friday, January 13th, 2023. Well, welcome to the bear market rally. Yes, we had some terrific information about CPI yesterday, and today we kick off earnings seasons, and it's going to be a very interesting trading phenomena coming up, and let's take a quick look right at it and all our data. All right, so what are we gonna do today? We're gonna go over a couple of things. We're gonna go over basically, fundamentally, has anything changed with the recession data coming out? And we're going to go over a little bit about some technicals, and we'll show you some actually live charts. And then from there, we're going to wrap that all up and tell you about some of our trades and how you can progress short term going forward. So recession, okay. Well, let's face it. We're going to be in a reactive trading situation for, I would say, the next 30 to 60 days until we can start getting a trend to form. And just to really eclipse that, we have year-over-year inflation. December came in at 6.5 from 7.1 in November. So all the items less food and energy rose 5.7 over the last 12 months compared to 6% in November. The index for all items less food and energy, however rose 0.3% in December after rising 0.2. So a couple of things. They've released all that strategic reserves. They filled up Europe, for the winter months. Basically, we've kind of flooded the market, so we've gotten energy prices down. They're still, well above, we're not paying $2.20 a gallon in gas here in the Northeast like we were, 2.5 years ago, but, it's down in the $3.20. So big cry from the 5.20s and 5.50s. That helps. Unfortunately, utility bills have almost gone up 70 to 80%, and that's going to start hitting people the last couple of months, and then now here in the winter months as they try to heat their homes. So we're going to still see this crunch on recession. And let's face it, 6.5% inflation is far cry from the 2% that we're looking for. Yes, if you start looking at how month over month it's gone down quite a bit, and we're not getting that raised month to month like we were in the past, and you annualize that, you can kind of convince yourself, oh, we've got a low inflationary rate. As far as going up, maybe, we don't know, but for now we've kind of put the brakes on things for a little bit. Number two, inflation's still here. I mean, when 6%, 7% inflation, it's still going to affect, it's going to put pressure on companies because wages, if there's the job market that stays the way it is, and that's really the canary in the coal mine, what's going to happen? People are going to be able to go to a different job and then get higher pay, and it's going to just the spiraling effect. And we're already starting to see it in the high-tech sector, as we've talked about in our market reports. That's the other thing. Go to TwoMeStocks.com. That's the number 2, MEStocks.com. There you get all the information, and all our subscribers can get the trade tracker and all our alerts and our stops that we've added and changed, etc. So the 4 tenets of recession, inverted yield curve, is still continuing. 2 negative GDP. We had 2, and then we reversed that, and it looks like we should have another positive quarter. So that's off the table. PMI below 50. Now that's joined by the ISM service sector below 50. Contraction below 50 means less. There's going to be less building of inventories because inventories would pile up, so people aren't going to build to put it in the warehouse, right? They're going to need less supply of raw materials. The service sector below, that means the demand for the service sector is going down. Delta Airlines came out today. Perfect example. They said, yeah, demand's good. Things are positive, but yet the cost is killing us for, the labor and blah, 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 et cetera. So, now their stock's down quite a bit. So these are the things that we're going to see during earning season. Everybody's adjusted their earnings to reflect the slowdown and the cost. So of course they're going to look at, we made our numbers, but the outlook is, if you compare it to year over year, it's not as robust, right? So that you have to, companies don't want to say, hey, we missed our numbers. They want to say we made our numbers, but we made less per profit than we did before. So expanding unemployment, it's starting to hit. It's a white right now. It's a white collar sector kind of recession that's hitting the high tech. We'll see how deep and far it goes, right? So like I said, we're going to go live to our stocks, and we're going to go over some of our things right now. All right, we use the SPY as our overall, where is the direction going? And this is, if we go back to 2022, you can see the downtrend continues, right? And what has happened? Every time we bump up against this upper trend line, we repel. Well, certainly we did that mid-December, and bang, we came down. What changed this time, and this is a surprise, that it did not go back to the lower trend track line. It didn't even come down 50%, just about. And now we're back up against the upper trend track line. What is the RSI? The RSI is 58.99. Let's see, the last time we bumped up against that, the RSI was up at 63. So we've got room to go. And then, of course, when we went eclipsed it, the RSI was only 56. So what is that telling us with the RSI at 58.99? We're getting closer to overbought. We haven't quite got there. It's up against the 200 EMA. From a technical perspective, we've got some resistance ahead. We've got a buy signal underway. The MACD is positive, but it's only 0.29. The stochastic is a healthy 93. It all looks like we want to get up to the last highs. We're not in the prediction business, but that's where it's going. The problem is we've yet to really beat this upper trend line. Yeah, we kind of we play around with it. We hit it a couple of times and bounce down. Well, this is we're going to be 1, 2, 3 within the last, sheesh, what was that? December 1st. And then we hit it again the 13th of December. And here we are, January 13th, and we're just hitting the top of that. So that's promising that we're testing that upper trend line several times. Once again, we've been playing with this 200 EMA for quite some time. If you look at this blue line, see if I can highlight it. I'm going to make this a little bit smaller. Look at this blue line, the 200 EMA, right from mid-November to the beginning of December to mid-December. And here we are, January, we're hitting it again. So we haven't been able to go beyond this 200 EMA for a lengthy period of time. This is a test, technically. We've got a buy signal. It's quite early in this test of the 200 EMA. And, with the CPI data, that's a reactive trade, came out yesterday. Everybody's like, oh, inflation's over. Inflation's not over, folks. This is a bear market rally. If it continues, terrific. We'll ride it. And then if the market trend changes for a longer term trend, terrific. But this is not going to end well. So you have to be careful. Yes, we are long. And, this is the whole idea. You get the buy signal, right? We don't get in at the bottom, which would have been here. I mean, we're not timing the bottom. This is the SPI, but we wait for a confirmation. We go in, and then we ride it as long as we can. And right now we're at this reflection phase where we're starting to get to the point where, we got to be careful. So we're going to put in our stops. We're going to make a third stop here, and this is what you should do. Then we use the 9 or 10 EMA, whatever you prefer. It's a quick oscillating trade. So that means, it should, if you see this black line here, this was using as a repelled that, and now we're above it, and we're going to use that as support. So the first line of support is that 9 EMA. So we're going to put our first stop there, and it will just be a hair above our buy. And then the next one is the 14 and 20 EMA, and that's right around our buy. So what we'll do is we're looking for a little bit more upswing so we can put our first stop somewhere closer to where this last low was, excuse me, which would be, right about here, if you could see my cursor. But we're not ready to do that yet. That's the problem with reactive trading. It's in and out, and basically it's a slow bleed typically, because a reactive trade means you go in, the market kind of races up, and then all of a sudden you wake up, whoosh, it goes down. And, the futures today are down quite a bit, I believe. And sure enough, 268. We're getting the earnings out, and people aren't liking the earnings. So, yesterday's boom is, today's worry, right? That's reactive trading. All right, now I want to go to TLT. TLT is the 20-year treasury. We talk about the inverted yield curve and all that. This is a perfect example. Look at this. We were short, all during, several times last year we went short the TLT, and it worked out very well. Now what are we doing? We're getting a little bit of a gain, and it's, repelled. It looks almost like the SPY. It didn't come back to the last lows, and now we're trying to get up to the last highs. Look at the 200 EMA is way up there. So this is quite a way to go. We are long. We got our buy signal. We went in actually a little bit earlier. We went on what we call a mouse hunt. We'll go over that some other time. It's in my videos, but with that said, we got in, and the same thing, look at this. Yesterday, it came all the way down to the 9 EMA, got repelled, and now, it closed way up here. What did it close at? It closed, I think, at 107.76. And it is, right now, TLT is 106 something, I think, 106.76. 20-year Treasury bond doesn't move 1% overnight. It doesn't. I shouldn't say it doesn't. It has been, but that's the reactive trade, right? So we're going to open the market, a whole point down. This is just, this is what reactive trading is all about. So people are really nervous. They're not convinced. The pundits are going to say, "Oh, recession is cool." All the experts are going to say, the Fed's going to have to slow down rate. How many times have we heard that? Multiple times. So how do you trade that? Well, right now you got to get your, TLT. We're in there. The first stop's going to be down here. Yesterday's low, and it may kick off today. I don't know, but we're going to see. And again, our second, third is right below that. And then we hold the third, and lo and behold, we'll be right at the buy. This is the problem of reactive trading. Look how narrow this trading band is, right? This is, it doesn't move that much. Oh, look at all that narrow trading band. So if we truly are going to see interest rates abate, we're going to raise them in February, right? Whether it's 0.2, 0.5, and we know that we're going to at least get 0.75 for the first half of the year. Basically, if the 20-year Treasury yield if the yield of bonds come down, that means the interest rate paid per bond is less than it was previous. Yields come down, then TLT goes up. So if in fact inflation is going to abate, this should be a little bit of a tell. It should race ahead 3 to 6 months before the market. We've got to get up to the last high, and then beyond that, we got to get to the 200 EMA. If we start seeing that, then we can say this market's got some legs. Right now, we're not sure. All right, so that's the nutshell. I know I'm not, it sounds like I'm on the fence, but I want to tell you, you got to be careful. We're long deep and heavy, and we're going to start getting stopped out. That's okay. We're still going to walk away with a profit. The reactive trade is what's killing everybody. Now, look at the diamonds. This is the proxy we use for the Dow Jones. We talked about this multiple times. The 9 EMA has crossed above the 50 EMA. That's what they call the golden cross. It's not everything to everybody, but from a technical perspective, it means the positive bias to the market doesn't happen that often. And when it does, especially when it went negative in April, everybody's like, "Oh, the market's terrible." The difference is this time A lot of people use the smooth moving average, typical, just a moving average, not an exponential, factor, and that has also been positive. So the crossover. So we haven't heard anything about that in the marketplace. That's because the SPY hasn't made it there, but we haven't heard that, and basically people are ignoring it. Very interesting. We got the buy signal here as well. I didn't, I trade the 200% of the diamond DDM, and it's a quick trade. I usually don't have the my subscribers trade that because it's you got to be on top of it, and it's a fast mover. But with that said, this is the same thing as the SPY. Will we get up to this last high? That's the goal. The diamonds or the Dow Jones have been much healthier. The other thing is IWM. This is very interesting. Small caps are raced way up, and it's above the 200 EMA. This has been a good trade. We got the buy signal just recently, which is it took a while to develop, right? In reality, it went up quite a bit in a short period of time. So this is very promising because if small caps do stay above this 200 EMA and start getting some breath in the market, this should be interesting. So this week, look for the market report. It'll be on the website, the number 2mestocks.com. We'll go over all the technical data, the advanced decline, the RSI, and we're going to give you a snapshot of where we think the market's going to go. But for now, we're long, and let's look at some of our trades. Let's see. All right, so we're long the TLT. We're up 3.3%. That closed yesterday at 107. It looks like it's going to come down to 106. I also went to the UBT, which is the 200% that and that. So what I'm going to look for today, I'm going to add to both these because at the market when it opens, and then if it does come down a little bit more, we're gonna see. I don't expect the market to reverse today, but we might see some pullback from yesterday's gain, and that would be healthy. That would be healthy. We're also long the small caps, and that's up. We use Schwab, SCHA. Not the best trading vehicle. It's their ETF, but it does mimic the IWM, and it's a little bit lower priced. We did get out of our short the Russell 2000. You can see we took a couple of negative hits there. All right, so Verizon's, that's our dividend play. That one we're watching closely. If there's any pullback, we're going to get out of that because that should not move much. And last year we saw a 20% decline from the highs. So we're almost at our first sell signal there, and we're not going to fool around with that. But that's our dividend play. And we expect to be able, if we can hold that dividend's like, oh, it's up there. So we want to play that if we can. Coca-Cola, we got stopped out. Goodyear Tire, this is a slow mover. We're gonna have to. I've sent out alerts for all our stops for our subscribers. We're gonna get stops in there. That's up 5% in a week. We got in there on the 9th. The NLY is a capital management. It's similar to a REIT. That's up. That's got a dividend of 16%. We're in that. That's up 3%. We're looking to see, even if it comes down 10% for the year, you're still going to be up 7%, 6%. If it goes up 10%, you're going to be up 26%. We're going to see if we can hold that all year long. NLY, if you want to look at that on a quick trade, NLY. So you want to get into this when it's you get some lows. Look at that. There is some fluctuation. And basically over here, if you look, you had a kind of a flat. This is not really much movement, but you saw this huge downtrend. And that's when, we started playing that when we got this leveling out. We're looking to, if we could stay between 20 and 23, that's what we want. 10% on 20. If you get in at 21, 10% drop would be, 18. So that's one that it's still room to get in. It's starting to flatten out again, which is what we like. We see how the trend line now, it's starting to gap here. And that's telling us that the price is abating a little bit, but that's okay. It's a dividend play, so that's well worth getting into. Let's see, MGM Resorts. This is a market sector that took off and is flying, and we expect that to flatten out a little bit. If you want, we'll take a quick look at MGM, and that's one you got to kind of hold off and try to get in on a drop. Do not get in it today because look at this. We've had quite a bit run up. And then the goal here, we look at our weekly. The goal for MGM is to really get back up into this flat area. It's going to be tough. It's going to be tough. My guess is, we're going to. That whole sector has really run up. This needs to catch up. If we look at the daily RSI, it's already at 65. So this is one I wouldn't buy now, and we're going to tighten our stops on that. XLI, the industrials, that you want to get into that anytime there's a pullback, and today might be a good day for that, depending on where it is. XLI, again, the RSI, here we go, 63. We're starting to get oversold. When we get up mid-60s, we pay attention. But this one, now, we look at the SPY and the diamonds, and we said, oh, the last high. Well, this is at the last high. Okay, this is at the last high. So that's a predictor. The industrials has been very strong. And that is, again, if we can eclipse this and we can start taking some breath and move in the marketplace, the weekly RSI is 61. So it's pushing, and we're getting at an exhaustive level. But if we can get up to the last highs, 107, that's a very promising look. But we're gonna have to wait and see on that. So that's why I'm telling you, these are the things you want to look for. You want to look for, these reactive trades. Don't hang around. Get your stops in, and if you have to get back in because the market takes off on it, terrific. But in a reactive trade mode, these profits are going to evaporate very, very quickly. We're also in EFA. You want to take a look at that one. That's a slow gainer, but we expect that to get some width. Borg Warner, again, the low PE. This is a stock that we don't, Goodyear, Borg Warner, MGM. We're trying to get into something that's going to have not a lot of fluctuation and a lasting trend. We don't expect to race up and be a 20% gainer, but we'd like to get 3, 4, 5%. The XLB materials, you got to get into that one as well. This one, again, it's this is the problem. If you don't get in these buy signals, and we do alert our subscribers at these buy signals, if you buy today, it's too late, right? But if you get in here, we just, we got in at 79 or whatever it was, 80, and then it races up. So it's again near the highs. All the charts are looking the same from a technical perspective. We've got to break those next levels. Okay, so the gold miners, we're in that as well. That's kind of like the material sector, but it's a very specific area. The pipeline, we got back into PAA. That's our dividend play at 7 points. So we've got NLY, PAA, and we've got Verizon. If we can hold these during the year without a lot of fluctuation, you're getting 7%, you're getting 16%, you're getting 6%. Those are pretty good dividend plays. The problem is we haven't had a lasting trend, and they get thrown out very quickly. XLU, we've been in and out of that. We're back in it. And again, we've updated all our stops, so subscribers look for that. So that's our trades, folks. I want you to go to TwomeyStocks.com, the number 2, MEStocks.com. We're in a bear market rally. If you get in when we got our alerts, you're in pretty good shape. Tighten those stops. If we get a pullback, and we get stopped out, we can always get back in. But these bear market rallies are very, very reactive. And when they drop very fast. Do not expect that to happen in the next couple of days, but we will get some weakening the next 4 or 5 days for sure. Mid-market, mid-month is typically a little bit of a flatter trade. If we can serve here and stay sideways, very positive sign. And as far as the pundits telling you the Fed's going to pivot and all that, if you hear, disregard that. The Fed is not pivoting. It's not going to happen. Are we going to lower interest rates at the end of the year? Only if we have a catastrophic economic failure. We're not on course for that. But things are definitely slowing down, and that we need more stimulus versus demand, and the stimulus is coming in the way of this infrastructure, but that's going to be, once you take away that stimulus, it all falls down, and the stimulus is not helping the high-tech sector. And, some of these, engineers, I was one, I know what it, before I had my business, but the bottom line is that engineering sector, once they're laid off, it's like, oh, they can go get another high-paying job. It's not so easy, because that technology sector is all that stays down for quite some time, and they're very specific technology. They're not going to go and get a job building bridges. It just, if you're a software engineer, are they going to hire you to build bridges? Are you going to put on a jumpsuit and go work on the roads? I don't know. I don't even think they'd hire you for that. So it's going to be an interesting 3 to 6 months. That's the Twomey Stock Market Report. Today's an exciting day. Let's see. It's about 9:04. What are the markets telling us? They are saying, come on, Mr. CNBC. Well, they're going to tell us something in a second here. There we go. Dow futures down 278 points. So if this rebounds today and we end up in the positive area or neutral at the end of the day, very positive sign. I would expect to be able to get in TLT and a few other XLI and maybe XLB. Take a look at those. If you can get in there low, put a tight stop to the low of today. And there you go. It's a reactive trade. If you're going to, we are a trading company. The Twomey Stock Market Report's all about trading. We'd love to recommend long-term investing. That's our mutual funds. The only thing I'm recommending long-term now is short-term bonds, utility bonds, or municipal bonds. And, you can get 4 or 5% in those. And there are some long-term CDs that aren't so bad. And, I know it doesn't beat inflation at 6%, but, if you can get 4 or 5% on your money, take it. There's nothing wrong with that. Don't put it all there, but it's a lot better than losing money in the stock market. On the Twomey Stock Market Report, thank you for listening. More updates, TwoMeStocks.com, the number 2, MEStocks.com. That is going to be a very interesting newsletter. Go get that on the website this weekend. Thank you.